Welcome, ladies and gentlemen, to a new series of our virtual roadshows from Swiss Resource Capital and Commodity TV. My name is Jochen Steiger. I'm the CEO from Swiss Resource and also the founder, and of course, the founder and chief editor of Commodity TV. Welcome. And also with me here is Tim Warman, the CEO of Fiore Gold. Good morning, Tim. How are you?
Morning, Jochen. How are you?
Perfect. Thank you very much. All fine. And I see already people are checking in here. That's fantastic. We give it another minute maybe. And the good news is we did the last virtual roadshow with you on 5th June, I think, and the stock price was 97 cents. I just checked that. And today we are $1.68. So it makes sense to watch those virtual roadshows. That is fantastic. No, well done, I must say. And you had some fantastic news, which you will share with us in a minute. Let me do some general remarks here for our incoming participants. First of all, again, welcome to everybody. Thanks for joining us here today. It's 5 o'clock in Switzerland. And we are keeping your privacy completely. We are fully complying to European Union data security laws and also to Switzerland. So nobody can see each other. Nobody can see the emails, email addresses, nor the names. And also what is very important, you find in the vertical gray bar, the third point is called chat. So please type in your questions when you have some, and we will answer that after the presentation from Tim. Yeah, first of all, again, welcome. People are still checking in here, but we will start in a second here. I must say Fiore Gold, fantastic company. It's still a small producer, but very profitable producer. The Q2 numbers were, again, records. They were fantastic. The company has $34 million of working capital now. And what is also even more important for me is the earnings per share were 6 cents, and that is a lot of money also regarding to the share price today, because if we move that onwards, we can probably expect in Canadian cents then approximately, if everything goes well, I would say between 15 and 20 Canadian cents. And this is from my side an estimate, not from the company, for the regulators here. For this year, this is a little bit of my feeling. So we are talking about a PE ratio here between 10 and 12, and this is still very cheap, especially if we look companies like Tesla. And which lost 80 billion yesterday market cap. So things are going well. Gold prices are rising as per today, really looking fantastic. Also, the silver price is rising. And this, of course, helps all producers out there. And I would suggest that we are now starting, because I think everybody should be now in, slowly but surely. I will set up the presentation, Tim, and then I say the floor is yours.
Fiore is it's a Nevada gold producer. We have 3 projects. One, the Pan mine in Nevada. That's a small gold mine, produces between 45 and 50,000 ounces a year. But more importantly, generates very strong cash flow. We generated about $8 million in free cash flow in the last quarter, about $10 million in operating cash flow. And that's despite doing quite a bit of drilling. And that strong cash flow really drives the growth of the company. It's allowed us to advance the company. We have not raised equity in the last 3 years. We do not take on any debt. We have no corporate level debt. And yet we've been able to advance, increase our gold production, increase our profitability, and again, push ahead on our Gold Rock project, which is our organic project, our organic growth project. It's right next door to Pan. It's about 12 kilometers away in Nevada. We aim to get that into production sometime in 2023. The project is currently undergoing a feasibility study as we speak. We put a PEA out earlier this year, but most importantly, it's federally permitted, and that is one of the big long lead items in the United States. Permitting, in fact, for Gold Rock took 8 years, but now that that's behind us, it puts us in the driver's seat to get that mine into production as quickly as we can. Once that mine is in production in 2023, it will, in combination with Pan, have us up over 100,000 ounces a year in Nevada. And of course, we'll be looking to continue to grow through some strategic M&A, adding other assets with the goal of becoming probably a dominant mid-tier US gold producer in that 150 to 250,000 ounce a year range. I mentioned briefly that we have not been impacted by COVID-19 in any really significant way. Northern Nevada has been spared the worst of this outbreak. We do a lot of testing, obviously, a lot of keeping people separated. They wear masks at work when they're together with other people. We don't have the big meetings and things, but overall, neither Fiore nor its suppliers or distributors has really seen any significant impact. We are Western U.S. focused, 2 mines or 2 projects in Nevada and 1 in Washington State. The Pan mine is a very typical open pit heap leach operation, the kind of thing you'll find all across Nevada. 2 pits, the North Pit and the South Pit. Those pits are joined by a fault that runs for about 10 kilometers through the project. We mine from both those pits. We bring the ore to the heap leach pad, run it through a single stage crusher. We leach the ore and we produce gold doré on site. We sell that to the refiners. It's primarily a gold mine. There's no significant silver, in the ore. It's a very safe mine. We've just won the Nevada Safety Awards for the safest mine in Nevada for the 5th time in a row. We've never had a lost time injury, and that focus on safety really translates, I think, to an operational focus right across the mine, which is why the mine runs so well and generates the cash flow that it does. You can see over the last 3 years, and keep in mind that Fiore operates on a modified fiscal year. So our fiscal year begins on October 1st and ends at September 30th. So we are actually just coming to the end of our fiscal 2020 at the end of this month. Each of the 3 years that we've been in production, we've increased gold production. We'll be guiding somewhere between an 8 to 16% increase in production this year over last year. And as we go forward, as the mine hits steady state, that rising gold production trend will start to level off as the mine hits its stride and starts to hit that kind of steady state, operation. In terms of costs, we typically, when our strip ratio, that is, when the ratio between the amount of waste we have to move relative to the amount of ore, is at about 1.6, which is the life of mine average, we typically sit between $1,000 at a mine level and around between $1,000 and $1,100 at corporate level. This year, we've had a slightly higher all-in sustaining cost because the mine went through a higher stripping phase period. That is now behind us, and we are now back to actually a little bit below the life of mine average, and that, of course, is going to bring some of the costs down. We've had very strong production the last couple of quarters, over 12,000 ounces per quarter. As I said, we generated about 3.9 million in operating cash flow in Q2, about 10 million in operating cash flow in Q3, and about 8 million in free cash flow in the most recent quarter. So with the mine really hitting steady state, the focus has been on exploration, continuing to extend the mine life. We just wrapped up a 28,000 meter drill program in April of this year. That's now with the consultants and the engineers doing a new resource and reserve update and a new life of mine plan. And we hope to have that out in the next couple of weeks, certainly by the end of September. So with Pan running really well, the focus has turned to our organic growth project, Gold Rock. As I said, Gold Rock is about 10, 12 kilometers away in a straight line. There's a small open pit there left over from the late 1980s when there was a brief mining operation there under a company called Echo Bay. What this open pit does is it shows us the ore body, and you can see that pinkish whitish rock there in the background of the pit wall. That's the ore body, that's the mineralized zone. And that continues on for about 18 kilometers from one end of our property to the other. And it is a very large property. It's about 200 square kilometers we have here under claim in Nevada. And you can see that large land package here outlined in green. You can see the Pan deposit in the upper left, the Gold Rock deposit in the lower right, the proven and probable reserves and the measured and inferred resources are shown in red. And all of the exploration targets that we have yet to test are shown in yellow there. So you can see there's a lot of exploration potential in and around both Pan and Gold Rock. Right now, Gold Rock sits at about 400,000 ounces of indicated and about another 85,000 ounces of inferred. It's about 30% higher grade than Pan. We just released a PEA on that project based on that particular resource, but because of the really excellent exploration potential there, we are currently doing about a 70,000 meter drill program at Gold Rock. We have 6 drill rigs turning there right now, 3 core rigs, 3 RC rigs, and they'll be drilling there for the next several months with really the goal of getting that measured and indicated resource base up or into around 750,000 ounces. That's the target I've set for our geologists, and that will be the basis for the feasibility study that we're currently undertaking. And that feasibility study is scheduled to be completed about this time next year. I'll just show you the some of the results from the PEA. It shows the two operations not operating as separate independent mines, but really operating as satellite deposits. So we already have a team, we already have a contractor, we already have an administrative staff and facilities at the Pan mine, and that same team and those same facilities will be used to run the Gold Rock operation. So the intention is down at Gold Rock, we'll just have an open pit mine and the leaching facilities, and then we would hope to bring the carbon, the loaded carbon that contains the concentrated gold, up to the existing plant at Pan, and we would remove the gold from the carbon and produce gold doré at carbon for sale to the refineries. And so we utilize a lot of the infrastructure that already exists. That obviously has a big savings in terms of operating and capital costs. We also use a lot of the other facilities, the office facilities, the assay labs, and the power line, the access road, all of which we don't have to build for a second time. They either can be used as is or might require a little bit of expansion. But again, much, much more efficient than building these things in duplicate. You can see some of the numbers from the PEA there, 56,000 ounces of gold production per year for about a 6.5-year mine life. We're hoping to improve on that significantly with the current drilling that's aiming to increase the resource base for the feasibility. And you can see some of the cost metrics there and some of the valuation metrics as well. The interesting thing is the gold price has been changing so fast that the highest upside case that we did for this project at $1,700 gold is now about $200 below the spot price of gold. But in any case, the economics look great on this. And one of the key things that came out of the feasibility is that there are lots of room to improve those economics, both through geotechnical drilling, through increasing the size of the resource and the reserve base there, and also doing some metallurgical testing, all of which are underway right now. And again, that feasibility is scheduled to wrap up about this time next year. I'll just talk a little bit about our third project called Golden Eagle. And this is often overlooked. It's a project in Washington State. We acquired this and the other two projects out of bankruptcy of the previous owners. And one of the interesting things is, just on Pan alone, Pan generated $8 million in free cash flow last quarter. We bought all three of these assets back in 2016 for $5 million in cash. That was it. And so a pretty good return on investment. I kind of think it was the deal of the century. But anyway, Golden Eagle is an often overlooked, as I said, third project up in Washington State, just outside the town of Republic, Washington. That's an old historical mining district just south of the Canadian border. It's been producing gold since the 1800s. The last two mines in the area, Kinross's Buckhorn and Kettle River mines, just went on care and maintenance in 2017. And one of the interesting things about this is that this is an open pittable deposit. It's 2 million ounces at 1.38 grams per ton. It is a sulfide deposit, so it would need a mill. But the biggest issue we have is that the edges of the deposit, the edges of the pit rather, not the deposit itself, which is entirely on our ground, but the edges of the pit would need to go into ground owned by Hecla Mining on both sides of us. And so at a bare minimum, we would need what's called a layback agreement to allow us to mine the edges of that pit into Hecla's ground. But when we started talking to Hecla about this, about 2 years ago, really, they told us that they had been doing a lot of drilling on their side of the property, and that they had drilled off what they could see being about 1.5 million to 2 million ounces. And so at that point, we said, well, look, why don't we put our two projects together? Much better to have a 3.5 or 4 million ounce deposit than two adjacent 1.5 to 2 million ounce deposit. Let's put them together and develop them that way. That conversation has been a very slow one with Hecla. They are not the fastest moving company in the world, but fortunately, the holding costs for this project for us are about $10,000 a year. So we can afford to hang on to it as long as we want, but obviously we'd like to advance those. And I'm hoping that in the next few months, we'll have some news, some things to announce on that. As I say, in the meantime, it's a relatively simple project, but one of the ideas we have for this is possibly using it as the core of a spin-out company, because we think that right now it's overlooked by investors. It's not part of our Nevada focus. It's a little longer dated project. It's not as advanced as Gold Rock and obviously not producing like Pan. But as a spinco, let me give you an idea of what that might look like. So if you look at all of the undeveloped gold projects in the United States that aren't owned by one of the majors, by Nevada Gold Mines or Barrick or Newmont, right now, as it stands, Golden Eagle would sit at about the 6th largest undeveloped gold project in the US at 2 million ounces. It's just a little bit smaller than Integra Resources' De La Mar project in Idaho, so another northwestern US project. Right now, Integra has a market cap of around 300 million Canadian dollars, with one project in Idaho that's about the same size as Golden Eagle. Right now, Golden Eagle is sitting as a third project in Fiore Gold, which has about 160 million Canadian market cap. So we can see there's a lot of potential value to be unlocked if we can spin that out, give it its own management team and its own focus. If it were to be combined with Hecla's project, it would make it about the second or third largest undeveloped gold project in the United States, somewhat similar to the Stibnite project owned by Midas Gold, another Idaho project. Right now, Midas has about a $500 million Canadian market cap. And again, with a project that's a little bit larger than our Golden Eagle. So hopefully we can get some developments on that, but just a sense of what kind of value is there. 98 million shares outstanding, and about 29 million options and warrants right now. And 23 million of those are warrants that are priced at $1.70 Canadian. We're trading around $1.68 or $1.69 Canadian today. Those warrants expire in about 3 weeks on September 22nd. So those warrants will either expire unexercised, or they'll get exercised and bring in some more cash for the company. Either way, we're quite happy. That will be resolved in a few weeks, one way or another, and then there will be no warrants outstanding. There are about 8 million options that are held by everyone in the company, right down to people working in the assay labs, and pretty much all of those options, I think except some of mine, are currently in the money. We have, and again, a little out of date there, we have 17 million US in cash right now, about 40 million in working capital, and a market cap, again, that's a little out of date, about 160 million Canadian dollars, and analyst coverage by 5 different analysts right now. In terms of valuation, I think Fiore's stock price, as Jochen noted, has gone up considerably over the last few months, but I still think there's a long way to go before we're on a level playing field with some of our single asset developer and producer peers, many of whom are operating in far more risky jurisdictions than Nevada. So on almost any metric available, price to NAV, price to cash flow, free cash flow ratios, any of those things, I think we still have a long way to go before we're valued alongside our peers. And just a quick wrap up then at the end of the slide. We've focused on execution, on operations, and I think we've done a great job on that. We've taken a bankrupt asset, bought it for cheap, turned it around, turned it into a strong cash flow generating operation. We've got our development project next door permitted, and now a feasibility studies underway on that. We have a resource update out at our Golden Eagle, our third project, and plans to spin that out to unlock some value for our shareholders. And we've done all this, again, I can't stress this enough, without raising equity since 2017 and with no debt on the company's books. So lots of news still to come. We have 6 drill rigs turning at Gold Rock, so lots of exploration results coming there. We'll have lots of news as the PEA or as the feasibility study progresses over the next few months. We'll have drill rigs turning at Pan later this year. We'll have a resource and reserve update at Pan in the next couple of weeks. And then finally, hopefully some news on some M&A and some new acquisitions as we seek to become a multi-asset producer as opposed to a single asset producer where we are now. And I'll just leave you with a nice photograph of the Pan mine with the snowy mountains of Nevada in the background. Thank you.
Fantastic, Tim. Thank you very much. And we love those lovely big toys here running through the open pit and generate. Yeah, fantastic. Well presented. Thank you as always. And there are already questions. So let's move that here. Yeah, we saw already for Gold Rock, the 22.8% IRR. Ernest is asking about it. Looks a little bit like on a $1,400 gold, of course, with, yeah, let's say economically a little bit sensitive. But as you said, we saw at $1,700, you're already at 47.5%. Have you done some calculations with 1,900 or 2,000? Because that must really rock, right?
Yeah, it does. And the funny thing is, no, we haven't actually done those calculations. And as I said, at the time we thought $1,700 made a good upside case. And that was just earlier this year when we put that PEA out. But yeah, obviously it's geared pretty heavily towards the gold price. And one of the things that, we're pretty confident is going to happen is as we go into the feasibility, as we look at things like increasing the pit slope walls and make them steeper, that will reduce the stripping ratio, reduce the capex and the opex. We think those economics are going to start to look better and better. And particularly also as we grow the size of the deposit, to have a bigger resource base and a bigger production base to spread some of those fixed costs out over.
Fantastic. How does your current mining fleet look like? Meaning, do you have to replace some stuff? Are those more old, let's say, trucks and diggers and excavators, or what's it looking like?
Yeah, this is actually one of the neat features of Fiore. We use a contract miner called Leadcore to do our mining for us. So we don't own any of those trucks or diggers or anything. And so the capital costs and the maintenance costs and everything are all the responsibility of the mining contractor. Um, and that's all factored into our operating costs. So we pay, a portion of the operating cost goes to that maintenance and overhead. And of course, Leadcore, it's a great deal because Leadcore is a much larger company than we are. They're a big international construction and mining company, contract mining company. Their cost of capital is much lower than ours. Their ability to go to Caterpillar and negotiate volume discounts on the hundreds of trucks and loaders and things they buy for all their operations all over the world, it's much better than ours. We think it's better to focus on what we do, which is telling those trucks how to operate. We integrate their fleet into our operations very tightly. We have their staff helping us with mine planning and things. But one of the interesting things is, our mining cost per ton on that contract mining basis is as low or lower than some companies that are mining with their own fleets, and that doesn't include, them having to spend the capital to buy all that equipment and maintain it and replace it. So we think it's a very effective and efficient operation the way we have it now. That makes it a very low capital intensity mine. We don't need a lot of working capital going in the mine to maintain it. The biggest capital expenditures we have there tend to be when we have to build new leach pad expansions, and which is a good problem to have because it means you've found more resources and you need some place to put them in order to produce gold from them.
Okay. Would that change if you, let's say, well, we have pen in production, then we have gold rock in production, and maybe then we have golden eagle in production. Would that change when you have three mines that you can say, hey, we are now that large that we can go to Caterpillar, make our own deal maybe better?
It's possible. It's possible. Right now the plan is to do contract mining at Pan and Gold Rock because we'd use the same trucks, the same loaders. Obviously we'd have to get more of them in, but there's a greater efficiency when you have the same fleet and you can share equipment back and forth. And if one mine needs an extra truck, you just send it over there. But again, yeah, we always look at different possibilities to evaluate, whether they're more efficient, more cost effective.
Yep. Okay, super. Then Paul is asking, when do you think you have the target of 150,000 ounces reached? Would that be like 2023?
Yeah,
2024?
That's probably reasonable unless we can do a more significant acquisition. But ideally, we'd like to add somewhere between 50 to 75,000 ounces through a near-term acquisition, and then have Gold Rock up and running, which gives us another 50 or 60,000 ounces, and maybe we can get that production rate a little higher. In the feasibility study as we grow the resource, and that should get us well over that 150,000 ounce mark.
Okay. Then, of course, the question of the question, as Golden Eagle looks fantastic, why wouldn't Hecla buy the thing or buy the whole company or even Kinross? Ernest is asking.
Yeah, maybe they will.
But at a much higher price. My next price target in the point of figure is $2.50 Canadian for the stock. So still a lot of room to go.
Yeah. No, I mean, we've been talking with Hecla about different options for it. Whether it makes sense for us to buy their ground or them to buy us ground, or whether we JV it, or whether we put it all together and spin it out. And again, we don't have any kind of definitive conclusion on that yet.
Then another investor is asking, why do you have so many options and warrants outstanding? Who is your largest shareholder? Because you also said that you did no financing the last 3-4 years. From where does that come?
Yeah, so the 23 million warrants came from a financing we did in 2017 when we acquired these assets. We raised 17 million Canadian dollars, and there was a warrant there was a 3-year warrant on that. So that's where all of those warrants come from. And as I say, they expire in about 2 weeks, 3 weeks, whatever the 26th is. The options are just part of our regular option plan, and as I said, they're typically, it's a very standard option plan. I think we can go up to about 10% of the issued and outstanding shares as an option plan that's approved by shareholders, and that's really designed to give the employees some incentive and allow them to participate in the success of the company. As I say, we don't keep all the options in employees for management and directors like some companies do. We spread them throughout. Every employee in the company would have those.
Yeah, which motivates them, of course.
Exactly.
That's fantastic. And when we are talking, there was one more question also on the largest shareholders, please.
Yeah. So
Who are
right
that?
now
Who is
we
that?
don't have any single large shareholders. I think our largest shareholders right now would be Kinross. Kinross has about 5.8% of our shares outstanding, and there's a fund out of New York called Don Smith and Company. They own about a similar amount, 5.8%, and they came in as the two lead investors on our last financing.
Mhm.
There's maybe 35% of the stock is held through clients of a couple of brokers at Haywood in Vancouver. Those are the guys who originally put up the money to buy these assets out of bankruptcy. But again, there's no large block of shares in any one single hand.
Mhm.
Management and directors own about 5%.
Mhm.
Yeah, so it's pretty widely spread.
Mhm. Fantastic. Good. Then my friend Rainer from Frankfurt is asking, from an investor point of view, who do you think are your most important competitors? He thinks of Caliber Mining, Go Gold, and Integra.
Yeah, well, it's interesting because if you look at Go Gold and Caliber and Integra, well, Integra's not producing and is many years away from producing. They're still early on in the permitting stage. Go Gold, we know those guys quite well. They've got that silver releach operation in Mexico,
Mhm.
which I think they finally got working now. But they've obviously got a real exploration focus now. But again, many years away from being in production at that. Caliber is an interesting one, and they maybe are a little more, obviously quite a bit larger than us, but probably very similar in the sense that they've got multiple deposits, which is what we want to get into. Typically, fairly simple, straightforward deposits. Now, obviously, they're working in a lot more challenging political jurisdiction than we are. Working in Central America is always has its challenges, and I've worked in Central America and in throughout Latin America, and it's always harder. Nevada is a very simple, straightforward place to operate, and I think that's a real key advantage to us.
Mhm. Then, of course, the questions of the questions part two, and this has to come from a Swiss shareholder. What's about dividends?
Yeah, we get asked that a lot lately. So right now, I think a better use of our cash is to grow the company. I think that's a better return for shareholders. If we were to pay out a dividend, it would mean we would have to slow our growth profile down. And I think as we grow, particularly as we get over that 100,000 ounce mark, and as we become transition from a single asset producer to a multi-asset producer, I think there's a significant re-rating that will happen with the share price there. And I think that's the best use of our cash right now, is to focus on that. Certainly, as we get more established, as we get into a more sustainable gold production position, we definitely be looking at instigating a dividend policy. But I think right now it's better to plow the cash back into the company to grow it.
Mhm. And there's a question from George, which is also here on my list from my side. Do you need to raise capital to put Gold Rock into production? Or now with those gold prices and your fantastic, let's say, record production each quarter, let's say, can you stage that because you are also renting the mining fleet, meaning
Yeah.
contracting, and that you say, hey, you know what, those whatever, 40, $50 million we have to invest, we can push that out onto, let's say, 5 to 9 months, and we can easily finance that from cash flow, because I think that would bring you in a fantastic position.
Yeah, it's a good question, and obviously, that's something that starts to look easier as the gold price stays high and production stays strong. But I think it will probably at the end of the day require at least a portion of debt and equity to bring Gold Rock into production. Certainly, there'll be a significant contribution from our own resources. But yeah, I think the idea that we could finance it completely from our own cash flow is maybe a bit of a stretch at this point right now. But again, we'll see. And of course, we'll keep looking at all the options over the next sort of 12 months as we get through the feasibility, as we really start to nail down what the capex is going to be, and start looking around at what the options are in terms of financing this. I mean, one of the things that we really like is that from a lender's point of view, this is a pretty safe project to invest in, to loan to, because we already have a cash flowing producing asset right next door. And Gold Rock is more of an expansion project than it is a new build with an untested team. I think we've demonstrated that we can generate cash flow from these kind of deposits, and what that's meant is that there's a wider range of lenders willing to look at lending to us. and probably, with greater competition, you should see a lower cost of capital on that.
Yeah, would maybe a royalty or a stream make sense to you, or let's say like a gold loan that you are paying back in gold?
All of these are things that we're looking at, and we don't have to settle on anything right now. We can wait and
Of
see
course.
over the next few months, what the best option is.
Mm-hmm. Okay, fantastic. From your point of view, and I know the feasibility has to be done first, as you said it, but what is your feeling, giving your experience, giving, let's say, the Pan mine in comparison with Gold Rock? What do you think you have to bring up in the capex? Just a rough number. I know for the regulators, it's a forward-looking statement. Yeah, but just to give us a little bit of an idea, a little bit of a sniff, what it might cost.
Yeah, so right now in the PEA, which admittedly is a kind of first look at it and some relatively rough cost estimates, we think it's going to be about a $65 million capex bill. At least that's what the PEA suggests.
That's US.
We think we can actually get that down because about 25% of that capex was what's called pre-production capitalized stripping. So removing waste rock that overlies the ore in order to get at the ore and start mining. And one of the reasons that there's a fairly significant proportion of capitalized pre-stripping, it's almost 25% of the capex, is that there was no geotechnical drilling that was ever done in the area. And so we had to assume that the pit slopes would be relatively shallow. However, if you look at that old pit that's left over from the 1980s, that pit probably has slopes closer to 70 degrees. And those pit walls haven't moved in 30 or 40 years since that mine shut down. It's really just a bit of sloughing of loose material, loose rocks rolling off, but those pit walls are incredibly stable. So that gives us some optimism that as we do geotech drilling and as we actually get some data, we'll be able to change the design of the mine as we go into the feasibility, steepen up those pit slopes. And as you steepen up those pit slopes, you really drastically reduce the amount of pre-stripping that has to be done. So anyway, that's one of the key areas we're focused on to kind of add value in the feasibility.
Mm-hmm. We have also a question on the AISC, and that was also on my list here. You reported AISC for the last quarter of $1,085, but on a consolidated basis, it was $1,203 per ounce. So is the reason that you are already, let's say, pre-stripping, that you are already doing work for Gold Rock? Is that the reason why the AISC are higher, given the fact that Gold Rock is not producing yet, but consolidated completely?
Yeah, no, Gold Rock actually doesn't influence the all-in sustaining costs at all. So all-in sustaining costs are really the costs associated with sustaining your current gold production. So growth capital, like the money we're spending at Gold Rock, doesn't factor into that. The key things that would drive the all-in sustaining costs at Pan would be the stripping ratio, so how much waste we have to move, and also how much capitalized drilling we're doing there. So as we mentioned, we did a 70,000 foot drilling program, so about 28,000 meters of drilling. And that is to extend the resources and grow the reserve and resource life there, and extend the mine life. So that directly goes to the all-in sustaining cost line.
Mm-hmm. Then Ernst is asking, can you elaborate a bit more on the total resource and reserves, and maybe, let's say, also a bit on the future exploration potential, first of all, for the Pan mine, I would say, because this is the cash cow, yeah? And we saw in the presentation, we saw the red areas marked, which is the current, let's say, resource base, but around that was a lot of yellow.
Yeah.
So it looks to me like that you can enlarge the mine life significantly, right, through more drilling.
Yeah, that's our goal. And so the idea is at Pan, right now there's about 275,000 ounces of reserves. That was as of 2018. We've obviously mined some of that. And right now the mine life, if you just take on what was defined in 2018, the mine life would extend into 2023 at Pan, and then have a couple of years of residual gold production from the heap leach operation. Mm-hmm. As I said, we are just in the final stages of updating those resource and reserves, putting out a new life of mine plan, and we're hoping to add at least a year or two of mine life to that. Now, Pan, because it's paid for, it's already built. We don't have to go and finance it. We don't have to show a bank a 10-year mine life for that. We're quite happy running along with a 5 or 6 year mine life on that. And I think what our plan is to spend about $1.5 million to $2 million every year on capitalized drilling to go out and test those red zones and start to gradually bring those zones into the reserve and the resource base. We actually drilled the first one of those in the past drilling campaign called the Mustang target. It's up to the northwest of the North Pit at Pan, and we had some really nice intercepts there. Some long, good grade oxide material close to surface. We only put 8 holes into it. It was just really a first look. We didn't do enough drilling to bring that into the resource or the reserves. But what we'll do is on the next drilling program, we'll go back in and we'll put more holes in there at close enough spacing and enough holes to define that, bring it into the resource base, and add that to the mine life as well. So again, we're always trying to extend the mine life. We're never going to drill out a 10-year mine life because it's just not worth it. It doesn't make any sense economically. But we will focus on, adding gradually to the mine life and replacing the material that we've mined out in the previous year.
Great. Then also congratulations. You just received the Safety Award 2020 from the Nevada Mining Association. I think this is not only like that you are collecting an award. I think this is really, really important that the mine runs extremely well, right?
Yeah, it's key. I mean, look, at the end of the day, Pan is a relatively low-grade heap leach operation, and it has to be run efficiently in order to generate the kind of strong cash flow that it's generating now. And I'll tell you, one of the key leading indicators of how well a mine is run is the safety record. If you go to a mine, if you're ever on a mine visit or talking to company representatives and they don't want to talk about their safety record, run away. Because I'll tell you that if the safety's not there, the whole place is not running well. And so, we've never had a lost time injury ever in the entire time that we've owned our mine. We've never had an employee miss a day of work because of an injury. We obviously have minor scratches and scrapes where you have to put a Band-Aid on it or something, but nothing serious there. And there's such a dedication and focus on safety there. And it really, starts with a focus on the whole operation, making sure that everything is running smoothly, paying attention to what is happening, not letting things slide, focusing on the details. And that's what makes it run so well. And safety just kind of flows from that approach.
Then there's a question. Are you working on an upgrade of the listing? Meaning, because I think you're now still in the venture exchange, and I mean, you are a producer, and now with $170 million market cap, that should be possible, right?
Yeah, I mean, we've looked at, we've looked more actually at doing a U.S. listing. I think whether you're listed on the venture or the main board in Toronto almost makes no difference anymore. It's the same company that runs the exchange. It doesn't really change, much for us. But getting a U.S. listing, I think, would probably be more interesting for us. One of the crazy things about the U.S. market right now is that if you're a U.S. investor and you're looking for a safe investment in a gold producer, so you want to get 100% domestic U.S. gold producer, someone that only produces gold in the United States, doesn't have any exposure to any of these crazy places around the world like Papua New Guinea or whatever. We're the biggest. We're currently the biggest domestic gold producer in the U.S. right now at under 50,000 ounces a year. So if we can grow that company to that 150 or 250,000 ounce a year production range, I think we become an obvious investment choice for a lot of the U.S. investment funds, particularly the generalist funds who don't have time to do all the homework on political risk and all the rest, who are happy with Nevada and who know that they understand the politics and whatnot. And we would really fill a niche market there. We would be the only producer in the U.S., 100% U.S. domestic gold producer, kind of in that market range. So that's kind of our focus, which is why we're looking at a potential U.S. listing as well.
There's also a question on your background, meaning what makes you successful, aside that you are a geologist, and maybe also the team, because you have turned a bankrupt property into a cash cow, I would call it, and really making money with your mine now, and you have a fantastic developing pipeline. I know that's why I'm a shareholder since 80 cents, and I'm keeping my shares. That is for sure, because there's a much better way to go. And so can you give us a bit more of a background, please, here?
Yeah. So, I mean, look, one of the things that really, I think, sets Fiore apart is the team that runs here, right from our people at the mine to we have a very small office staff. We try to keep the people working at the place that makes the money rather than the place that spends the money. I'm a geologist by training. I've been involved with, companies that people in the mining industry and investors would know. I was the VP corporate development at Aurelian Resources. We're the ones who found the Fruta del Norte discovery in Ecuador. It's probably the best gold discovery of the last, probably the last 50 years. We sold that to Kinross for over $1 billion. I went on to I was the president of a company called Dalradian Resources with their Kernyault deposit in Northern Ireland, working with Patrick Anderson on that one. That company was taken private by Orion Resources. You know, and I've just been involved all over in the mining industry since then. And our team is the same. You know, we've got people who worked at Newmont, who worked at New Gold, who and in some cases, you know, our CFO, he's got experience outside the mining industry as well, which I always say is really great for the company because we try to run our company like a real business, not like a lot of gold mining companies who are just all, you know, fluff and speculation. We try to actually make money, and we try to make more money than we spend. You know, and I think, you know, like any business would in the real world. And I think that whole team comes together to you know, to make that happen.
Where do you want to see Fiore 2025?
2025, yeah, that's where I want to be. That's where I want to be, the 250,000 ounce a year gold producer, and you know, and starting to make some bigger acquisitions. You know, right now we can take on a 50 to 75,000 ounce producer, and that fits right in our niche. But once we get to that 100,000 ounce range, then we start looking for 100,000 ounce producers, and once we get that, then we start looking at, you know, looking for 200,000 ounce producers. So it's that kind of exponential growth that we're trying to get to. So by 2025, I think a minimum of 250,000 ounces a year production, ideally in the U.S., and really, you know, become the go-to investment target for U.S. investors.
Which makes me to keep my share still. There's another question. With as you have only pure U.S. assets, wouldn't it make sense to convert into a U.S. company with lower taxes?
So we actually are mainly a U.S. tax filer. We don't really have any revenue in Canada, so we don't really pay a lot of tax in Canada. And actually, the corporate tax rate in Canada is actually not that much higher than the U.S. So the so you know, our primary place that we pay taxes is in Nevada.
Fantastic. So let me double check here if we have got all the questions. Ladies and gentlemen, if you still have questions, please put them up now, because we are approaching now the hour, and then we are fine. No, I think I've done everything here. That looks great. Sorry, 1 second. Yes, that's good. Yeah, we are through it. Great. Also from my side here. Yeah, perfect. Tim, thank you very much. Well done. And as said, thank you. And as said, my chart analysis gives you as the next target $2.50. So that's another 45% room for the share price, which is great. And I said that, not you. That's important. And yeah, so we see it very positive what we heard. And thank you very much, Tim. All the best to Toronto, and have a great day.
Thanks, everyone.
Thank you. Yeah, ladies and gentlemen, thank you very much for participating here in our virtual roadshow. And yeah, the replay will be available probably by Friday, I think. And you heard it. It's a fantastic producing company, cash flowing. I call it a cash cow, actually. And also with all the options and warrants now almost expiring by 26th of September. This also cleans up, on the one hand, the share structure, but on the other hand, if they would be exercised, it brings a lot of money into the company, and even Goldrock would be almost financed with that. And I think with a 50 to 60 million US dollar investment into Goldrock to have the next producing asset here, this is a really foreseeable amount, and this is really doable. And especially, as you know me, my next gold price target is $2,440 for next year already. And I think there's a very good chance that we will see that. And with the production ongoing here with Fiore, that looks really exceptional. So check out the company. Thanks for watching us, and thanks for your attention. And yeah, hope to see you soon. We will set up for sure the next virtual roadshow. Probably will be with Sibanye-Stillwater then, and hope to see you there. But we have not fixed the date yet. So all the best. Stay healthy. That's the most important thing. And thanks, and bye bye from Switzerland. And bye bye to Tim. Thank you.